Hi there everyone, good morning. This is the market right here on ET Now. I'm Abandabash, with me Nikunj Dalmia as well as Anisha Jain, and it certainly has been a very happy new year. At least we did see record highs, but then pretty much flattish for the frontline indices, sideways for the third straight day, but I guess Nikunj, no one's complaining.
You know, Happy New Year happened yesterday, but today it's your birthday. So, Nisha, please join me in singing a song. Happy birthday to
dear.
you.
Sweet.
Happy birthday to you. Happy birthday, dear.
Avan.
Happy birthday to
Happy birthday to me. Oh, how sweet, you guys. Thank you. I'm so touched. Hopefully a year older and a year wiser as well, and lots to learn, of course.
Age is just a number.
Age is just
Age
a
is
number.
just a
Yes.
number. Like I say that, you know, in this bull market, whether it's 20,000
I
on
was
the
just
Nifty,
going to say, yeah.
just a number. It's just a number.
Exactly. So 21,800, just a number.
Avan and we've been together for 15 years.
Yeah, it's
Okay,
been-
I'm not
I
calculating.
don't have
the
that
age
old
then.
picture.
Not
I
being
don't
that
have,
rude.
I don't have the old picture. I've requested the producer to get it
Oh
up.
my
Avan in
God.
2008.
That would be fun. But I'm sure you haven't
Course
seen
of the
much
show,
at all.
we'll have it. Course of the show, we'll have it, I promise.
Yes, yes.
We'll
okay.
probably end with it. We'll start with
Yes.
the birthday wishes and we'll end with before and after.
Oh, lovely. Okay.
How, you would start with happy birthday and then you would end with a wish.
Yeah. fair.
So it would be, what do you want to wish for?
Best of health, best of everything,
Yeah.
you know, just be the best you can be.
Thank you. Thanks, Anisha. And thanks, everyone. But markets, Nikunj.
Yeah, it's your birthday, but we have to deal
I
with the
know, we
markets
have
as well,
to, we
right?
have
So, yeah, yesterday was a bit of a topsy-turvy ride, Nikunj.
Nisha, you can't read too much into yesterday's price action, frankly. I mean, we were working does not mean the world was working. Even Avan was not working.
Yeah.
So I would not read, frankly, too much into yesterday's price action in isolation to make a market view. But having said that, I guess now now there are two things which really would be at play, and which in a sense has been the template for 2020 for Jan of every year. One, will the seasonality kick in? Historically, Jan has not been a very gratifying month for the bulls. It is more down than up. Second, the flows. I mean, will we see large allocation coming back into markets from FIs? We saw evidence of that and what magic it did in the month of December and in November. Will that really continue? And see, are markets running slightly ahead of themselves, and irrespective of what tone and tonality we get from the corporates, are we likely to run into what could be called as buy the rumor and sell the news kind of an earnings season? I think for me, those are the templates which really would be at play. So if I put all the templates aside and if I have to make a market view purely on the Nifty, I would say that you may just be in some kind of a range with perhaps a flat bias for next couple of days. That's what market indicators are. Look at the Nifty, the put call ratio, the trend, and the kind of market movement we've seen. So I'm not saying you prepare yourself for volatility, prepare yourself for downside, but I'm making a case that maybe there is a case where markets in the next few days are just likely to linger along here and there with, getting tossed from the upper end of the range to the lower end of the range. You need something new for the market now to take a giant leap forward. It got one because of state election. It got the other one from US Fed. It was followed by FIs. What would be that
Next
trigger? Which is what I think markets would hunt for. There is no budget.
Yeah.
So you will not see that as a trigger. Earnings season, by and large, I mean, there's universal consensus that things would be strong. There is a pre-established view that flows will be strong. So there are a lot of pre-established views which markets have. And you need something more to add that spring to the stride for the bulls now.
Let's see whether we get that spring or not, because there was an interesting note from Kotak as well talking about how this year is going to be a tussle between fundamentals and sentiment, because if you go by fundamentals, the return is going to be modest, in fact negative for many, but the returns can vary because one can't factor in the sentiment, and that was at play towards the end of last year. So don't know how long can that really continue, and that sentiment has taken a lot of these companies to the 1 lakh crore market cap as well. In fact, a lot of new additions that we have seen since September 30th of this year. Of course, those public sector entities, the PFCs and REC of the world have got added in terms of the 1 lakh crore club. You also had a couple of these Tata Group companies, Trent and Tata Consumers, for instance, got added to that 1 lakh crore market capitalization group as well. And then the latest entrant being Macrotech, as well as a few other names like PNB, etc., that got added. So, Nikunj, I think if you look at the total number of these 1 lakh crore companies now, it's about 75.
It's such a nice feeling, I mean, earlier any company would go above 1 lakh. It used to be like 2 or 3 companies in a year. Now you've got like 10 companies which have just suddenly gone up in the month of December. Let's go to that list again. There are 2 commonalities. One, if you have a prefix Tata, welcome to the club. And if you have a prefix PSU, welcome to the club. I guess two groups. So look at PFC, RSC, Trent. Trent is a Tata Group company. PFC, RSC, they both are owned by Government of India, or they are PSUs. Flip it around, you will see a name like Tata Power coming to the 1 lakh club. Macrotech, odd one out. Tata Power, Tata Group company, GAIL, a PSU company. So Macrotech, I think, is the odd one out from 30th of September. But I mean, there are 2 bull markets in front of us, guys. One is PSU bull market, one is the bull market in Tata Group of companies. And both these bull markets, you would say, purely as the fundamentals of the market as such. These are not companies where you would actually have existential crisis. These are not the companies where you have a debt as a problem. These are not the companies where you would say that business is going to slow down. So the risk is a valuation risk, not existential risk. And I think for me that's heartening. Why? Because when some of the companies which have existential risk, when they go up, and when you know that the tide will turn, that's the time you have a problem. So I'm not very disturbed with the profile of stocks which are going high. See, Anisha, what Kotak is saying is absolutely right. In a bull market, crazy things can happen, and you don't know what could be the extent of that craziness. We are just in and around the long-term averages, so it's not that crazy things have happened.
Yeah.
Please remember, bull market peaks have always happened when things really go haywire and valuations are completely out of whack. With this kind of a fundamental underpinning of the economy and what is happening in the world, we are not even close to the bubble levels of what we saw in the last bull markets. So I don't think we are there yet, what could be called as bubble. And Naren, I think we'll take this part of his conversation out. And he said that, look, just because markets have gone higher does not mean it's a sell. Yeah. Because you don't know the extent of what it could go higher. And it was very nice where he said, and it just sort of stayed with me, which is that, Nikunj, the last leg of any bull market or the last phase of any bull market, you may actually see like a crazy move. We've seen parabolic move in small cap stocks. We've seen a hyperactive move in mid cap stocks, but we've not seen a parabolic move in large cap stocks. That's my limited point.
Yeah, that is true. And I guess even the levels that we're seeing at the current juncture, I don't think that was entirely anticipated. So to a certain extent, unprecedented, even the kind of move that we've seen so far for the markets. But speaking of these PSUs, speaking of them, entering the 1 lakh crore market cap club, the question is what the new year could perhaps mean for the PSU stocks going ahead. And we did speak with some of the top market experts, and they all sounded pretty optimistic. Listen in.
Longer term, the way their balance sheets have improved, I think general policy has been quite supportive to creating value in PSUs.
My personal feeling is that the leadership, as I keep telling, is very much intact with the public sector stocks. They probably have a largest way to go still, because typically if you see in the bull market leadership, the stocks go up 10x, 20x after some point. So I would remain invested in good quality businesses.
Look at the index, for example, the PSC index. Clearly, we have been much more positive on power within the PSU theme than other areas, because we felt that the power generating areas are still more reasonably valued compared to the other areas. And we have been more positive on the upstream areas in the PSU theme, because these were the 2 themes where the price to earnings was much more reasonable than many of the other PSU.
Okay, so that's a view coming in on the public sector entities and the bull market that we are seeing there. But will the bull market continue at the market level? Because yesterday we did hit fresh record highs, but a complete U-turn from there. What's the texture for the day going to be like? Let's welcome on board our experts, Naresh Mirani and Kunal both try to decode that for us. Hi, gentlemen. Good morning. Naresh, let me first come to you. A complete U-turn yesterday. What do you make of that?
So we saw some bit of selling in the last 15 to 30 minutes. Generally, we do see that on in the last day of the month or the first day of the month. Most of the times, last day of the month. There is generally a reject, sell, etc. But as of now, we would take it just as a last half an hour sell. and we watch out for whether we start seeing a follow-up action or we start again on a fresh note today. So overall, the fresh year starts today in terms of the whole world. The bias remains positive because yesterday also, even though the Nifty was not in momentum, we continued to see new fresh highs on the small cap and the mid cap indices as well. So the bias is positive, and the only way to ride such trends is to continue to trail onto your position, book partial profits. So overall, we may get into a zone wherein at some point of time we get into a range. So going forward, we'll watch out for that range. Maybe 22,000, 22,200 is the upper band. 21,400 becomes the lower band. So overall, stock specific action should continue to go on even in this range.
We were working does not mean the world was working, right? Can we read too much into yesterday's price action?
So I think yesterday, even the last half an hour, there was nothing in terms of the data which changed for the indices. I think there was just 1.2% change in the open interest, or a mild drop in the open interest for the Nifty, and 1.35 for the Bank Nifty, and that itself summarizes that there was hardly any major action in terms of the F&O from the index side. Even the individual stocks which had seen selling in the last half an hour or so indicated that there's no major unwinding of position or something for traders to worry about, especially for the guys who have been holding on to the positions from much lower levels. So, and we also believe that whenever the index gets into this kind of a odd correction, we wait for the follow through price action on the downside. If it happens in the next couple of days, I think that really determines that whether the trend has reversed on an immediate basis or whether we are just looking at a minor bout of profit booking, and then once things get aligned, the markets would probably manage to bounce back. So my sense is the latter, that we could probably be getting into the phase of a mild profit booking and then possibly the index managing to rally up higher once again.
Okay, let's take the individual bets also then. Naresh, what's the individual stock that looks strong to you on the charts?
So the first bet would be a buy on ICICI Bank. The stock has not rallied in the current move in the Nifty. But if you look at the charts, 1,000 was the previous highs a couple of times. After the breakout went to 1,040, 50 levels, retested the 1,000 levels and is still around that same prices. So it's a good risk reward entry point here wherein you have a 2% stop loss. And if this starts a rally from here, it could make a move towards 1,100 plus. So a risk reward buy here with a stop loss at 980, target price of 1,100. Second is a buy on Apollo Hospitals. The whole hospital sector as such has continued in a strong trend across the board. The small caps and the mid caps have actually rallied much more than the Apollo Hospital, and now we've seen a fresh flag breakout on Apollo. We could see a catch up and a new all-time high going forward. So buy at current levels, the stop loss at 56.50, target price of 6,100 in the short term.
You have it. Those are some top trading ideas from Naresh. Kunal, let's find out what are the top trades that you're betting on.
So I'll bet on RBL Bank stock heading towards a breakout yet again about 2,875 to 80 mark. Yesterday where it closed. So would suggest a buy with a target of 300. Stop loss could be kept at 270. And second would be a buy on Samvardhana Motherson. That's a stock which has given a breakout. We flagged off the stock a couple of days back when it was at 101 odd levels. Looks very attractive from a short term play. So even at 106, 107 where it closed yesterday, looks attractive for a further upside of almost 10% on the near term. 114 as a target. Stop loss could be kept at 105.
Okay, there you have it. Those are some of your top trading calls that are being flagged off by our chartists today. Let's find out what's in the news then. And Sumit's here to walk us through those details. And it's Zomato in focus. Platform fee being hiked. And I know the management always says it's always very marginal, but this tends to be a talking point.
Well, yes, the marginal number has actually come up from 2 to 3 to now 4 rupees in key markets. In fact, on the 31st of December, they were charging around 9 rupees of platform fee for every delivery. Now, what analysts are expecting is that, this is the earlier estimates what we had, is that every 1 rupee hike in this platform fee adds nearly 0.2% to the incremental contribution margin of the food delivery business, and it adds nearly 15 crore to the company's food delivery EBITDA every quarter, which means that the addition for the on an annual basis could be around 60 odd crore, which is nearly 15% of the consolidated adjusted EBITDA of Zomato. Now, this is important because 15% is a big number for Zomato, and as the number of users increases, this number could actually be well higher for Zomato going forward. Now, one important part here to notice is the fact that some few days back they had received a 400 crore GST notice from the GST department, and this was on amount collected by Zomato as delivery fees. Now, though Zomato believes that they are not liable to pay the amount, if at all they have to pay this amount, they can do this by increasing the platform fee. And given the fact that they have now increased the platform fee, just reiterates the fact that they have this leverage to go ahead and increase the platform fee and just offset the GST charges that they have to pay. Now, CLSA believes that this current hike could offset the impact by around 25%, and apart from this, they also have other multiple options to offset this GST liability that they can incur going forward. Now, first option is to increase the platform fee anywhere between by 3.8 to 10.7 rupees depending on the distance of the restaurant. They can also increase the take rate anywhere between 0.9 to 2.5%, and they can also increase the average order value by around 3.6 to 10.2%, again depending on the distance of the restaurant as per CLSA. So Nikunj, how do you see this increase in platform fee?
It's a pass-through. So you just think about it, it's an absolute pass-through. If this GST decision would have not come, would have they have increased the fee? The answer to that could have been well, no. But in terms of the positioning of stock, where it was exactly a year ago versus where it is right now, it was a stock which in a sense was on the receiving end. Everyone in a sense had written off companies like Zomato, Paytm. Today, I mean, Paytm has got other issues, but the entire space per se has made a comeback, and there's Zomato, I guess, at top of the rank. The fact that the platform fee is something which they feel is getting accepted now, it is also an indication that the pricing power or the convenience charge which a food delivery platform is now commanding, I guess that now is with the food delivery company rather than the customer. You know, there was a time when Zomato started, there was no concept of food delivery. There was a discount when you were ordering food. You know, it was like you were ordering the main course, you were getting a dessert free, and if you're ordering drinks, you were getting the milkshake free. I think that time is over now. Now convenience is coming at a price, and that's what I think the customer is ready to pay. So whether it is Swiggy or Zomato, the entire setup I think has changed. For me, 2024 I think would be a big turning point for the food delivery industry, because up until now, only Zomato is in the listed space and it is commanding disproportionate amount of premium. But in 2024, sooner than later, Swiggy will go public. And
in fact, Zomato in this time period that we are looking at 1 lakh crore has managed to again go above the 1 lakh crore market cap.
Yeah, so I'm saying just think about it. To right now, if you are an institutional investor, you have only one stock to choose. With Swiggy coming in, I guess it would be two. And for me, that time it really would be a choice. And that time the really Swiggy versus Zomato comparison would be done, I think, on a daily basis, on ongoing basis. When Swiggy go public now, Manisha, mark my words, every second report, every third brokerage, every fifth link in our newsroom would be in Swiggy versus Zomato. I think we will see that in 24.
Yeah, that's going to be perhaps a big trend for this year when Swiggy lists, what kind of impact it has on the other QSR as well as Zomato, of course. But the other stock that we want to discuss today is Lupin. Yesterday, of course, Nomura came out with a note on Fortis, and that stock reacted very positively. So, Amit, are we expecting something similar here? What's the rationale for hiking the target price so sharply?
Well, I can't say whether there will be a similar move or not, but definitely this is the second big target price hike that we are seeing for Lupin. In the last 4 sessions, 20th December, Spark had come out with an upgrade and a target price hike, and today Nomura has increased the target price to 1,593 rupees. Now, do mark that this is the highest target price on street for Lupin, and this target price suggests a potential of close to around 21%. Now, what they're saying is that the US pipeline could help drive growth on the current base. They're expecting EBITDA margins to improve over the next 3 to 4 years with US launches, growth in India and emerging markets, and as well as in Europe. Now, in US, they're saying that with clearance of the formulation sites, the product pipeline could unfold over the next 3 to 4 years. The company has been continuously investing in complex platforms and also in ophthalmic products as per the brokerage. Now, Lupin has secured the sole first to file position in 20 products and has shared exclusivity position in 33 of these products. And when it comes to the Indian market, they're expecting growth on the back of a field force expansion and chronic segment presence that the company has. Now, Nomura has increased its EPS estimates for FY24 to FY26 by anywhere between 2 to 14%, and this is on the back of higher products sales of 2 of its key products, and they're also expecting less competition in one of the key products. So basically, this is the broader reasons why Nomura believes that Lupin could actually outperform in 2024.
See, the stocks of 80%. So, you know, can you really make a case of re-rating for what you saw like in 2023? Looks difficult. But yeah, I mean, the lift-off for Lupin has been that it really follows a trend in a cycle. And whether it is on the upside or on the downside, 2019-20 or 2021-22 and initial part of 23 were very down cycle for them. Now I'm there in the up cycle. And typically for a company like Lupin or Pharma, when the product cycle is strong, when the up cycle is strong, they tend to beat estimates. So Lupin has managed to beat not only the estimates, Lupin stock has not only surprised everybody with a comeback, they've been consistently beating the estimates. The product life pipeline looks healthy. So without getting into specifics of price target here, it would be a reasonable assumption to make that for next 2 or 3 quarters, I think Lupin will come out with predictable set of numbers, and where chances of beating the market and surprising the market, I guess, is largely high, because that's how Pharma and that's how Lupin's previous trajectory has moved. There are no big bang launches from it. I was scanning through it, but the fact that they got biosimilars, the profile is looking strong, specialty chemicals, specialty pharma is kicking in. I will not be surprised that for next 2 or 3 quarters they could actually be in that revenue as well as profit beat cycle.
Just a monetization phase that we are now in.
Okay, there you have it. That's interesting to watch out for. The top stocks to keep on your radar in today's trading session. Well, let's tell you what we'll do right now. We'll take a very quick break right here on the show, but stay with us. When we come back, we get on board our research analysts to talk about the stocks to watch and discuss lots of top ideas with our guests.
Welcome back. A lot of stocks which are going to be in focus today, especially the auto pack. A couple of news flow there. Of course, you got the report card for the month of December, but separately there was a policy action as well, wherein the PLI scheme has been extended for auto companies and auto parts. But first, let's go across to Vinny to get a sense as to how the report card looked, and then we'll analyze this news flow further. Vinny?
In terms of the report card that has come in for December auto sales numbers, the last month of the year, nothing exciting that has come in on that front. Quite a mixed bag then we could say coming in for the auto sales numbers. Let's highlight the big trends that actually shaped up this time. PV, the sales of passenger vehicle, that actually saw moderation, and the sales over there continued to be a bit moderate on that front and subdued there. Commercial vehicle sales, that surprised in terms of numbers. A lot of positive commentary came in from the managements as well. Two-wheeler vehicle, month-on-month basis, that saw a bit of a decline, but year-on-year basis, obviously, we saw healthy growth in that front. So that was something, when analysts were looking at it, that was a bit of a positive side that came in from them as well. While tractors, that was a big miss versus the estimates in terms of the tractor sales. Let's look at just the scorecard that is shaping up over there. Now, Escorts, M&M Auto, M&M Tractor, Bajaj Auto, as well as Eicher Motors, Royal Enfield, that was below estimates of ET now. What did well was Eicher Motors VECV sales as well as Tata Motors CV sales. So CV, that was something that surprised in terms of numbers, and that is why above estimates as well. Inline numbers came in for December month for auto sales from Maruti, Tata Motors passenger vehicles as well as TVS Motors as well. So yes, that's how the report card is looking like for the month of December. Specifically in terms of PV sales, Tata Motors said that PV significantly strengthened their market positions and reduced channel stock sharply, and received excellent market response for the new avatars for the company as well, in terms of Nexon, Harrier as well as Safari, that was launched during the quarter as well.
Okay, thanks very much, Vinny, for giving us those details. Moving right on, a slew of stocks are expected to react to their quarterly updates. We've got Sharad here to break it down for us. Sharad, what are the quarterly updates like?
Well, yes, Q3 updates have started flowing in. First, we are having APL Apollo Tubes, largely weak set of numbers as the quarterly volumes fell almost 11% on a sequential basis. Now, the impact is, of course, coming in because of channel destocking, as there was an anticipation of correction in the steel prices. Also, they have stated that the new Raipur plant is expected to ramp up, and also the Dubai plant has started its commercial production in the December month. Also, we are having Dhanlaxmi Bank Q3 numbers were largely in line with deposits going up 11% and advances also going at the same rate on a year-on-year basis, largely in line. South Indian Bank, if you look at it, it's on the weaker side because of the CASA coming down at roughly 230 basis points, coming in at 33%, while a double-digit growth could be there for the deposits as well as advances ranging between 9 to 11%. JTL Industries, very strong sort of quarterly numbers coming in. It recorded its highest ever quarterly sales volume, with the sales growth coming in almost 76% YOY growth. Now, importantly, the value-added production contribution has also been very strong for the company. Ultratech Cement largely flattish to slight weak numbers coming in as the India sales volume picked up by 5% on a year-on-year basis, while a sequential growth was just 2%. The grey cement volume overseas also pulled up a 20% growth. Lastly, I'd like to point out Coal India. In the December month, actually the coal production levels did go up by almost 8%.
Thanks, Sharad, for that. But Sanjeev Bhasin also joining us on the show. Mr. Bhasin, let's start from where Sharad left off. The update that we've got in terms of Ultratech Cement for the quarter gone by, and it seems like it's a decent number. There's a 5% year-on-year growth, quarter-on-quarter 2%. What do you make of it? Because there has been a bit of a traction in cement stocks for the last couple of days.
Anisha, that will be part and course of the construction activity. As you are aware, in NCR and Delhi, because of the strong fog and cold, there has been a little bit of the state government has come out against construction activity and so on. So dispatches and consumption will be postponed for about a week or so. But I would use this as a buying opportunity in the sense that Ultratech and the 5 players, they control 53% of the entire market. At 138 million tons, even if a 10 rupee increase comes, you can imagine what the variables will be. And I think by first week of January, you will definitely see some price rise coming in cement. So it's a matter of time as the weather gets a little more moderate. I think construction activity, which has been at the best, will see more traction. You're seeing the same in infrastructure, in hydrocarbons, in real estate, and the demand let up in road construction. All that means cement and steel are a natural conduit for that. As a disclosure, Ultratech is one of our top holdings. We are very, very optimistic. And even though now there is not that much of room of comfort on the price, we still think earnings will be in line. So buy on declines would be the call for Ultratech, Ambuja, and Dalmia Cement.
Okay, fair enough. What about your strategy, Sanjeev, when it comes to the entire auto sales numbers? While it has been a bit of a mixed bag, it has been slightly on the softer side this time around. How have you read into the auto sales numbers?
Yes, Avan, that is what we have been foreseeing. So we have actually booked a lot of profit across the board in some of our top holdings. We continue to be overweight Ashok Leyland. Ashok Leyland, and if you recall from 160, 165, 170, Ashok Leyland will be the biggest beneficiaries of more CV sales. They are eating into the market share of Tata Motor. Their bus market is doing roaring business. Anything to do with electric vehicles, the bus side is seeing the maximum amount of traction. I can even state that Ashok Leyland is headed to 250 on a price performance. But the business is doing extremely well. They are in all their verticals doing, seeing the best traction ever. So Ashok Leyland continues to be a top pick. You can also add one of the OEMs which we think is going to do well is Motherson Sumi. We had a buy close to 65 on this. It has just started to see traction. But on the large caps, be watchful, particularly the two-wheelers and M&M. That is where you should take some money off home.
Okay, so take some money off the table when it comes to select auto names, but the likes of Ashok Leyland, etc. still look very strong. Naresh, I wanted to come to you on the metals pack because this morning Jefferies has actually written a note, and across the board there have been upgrades that came by. For JSW Steel, for instance, they've upgraded it to a hold. The target price is now 800 rupees. Coal India, the target price has been hiked to 450. Hindalco, etc. as well. And they say that they're cautiously optimistic on the sector given the volume growth that they're envisaging. But on the charts, what would you do with the metals basket right now, Naresh?
So metals is a tough trade right now because what we are seeing is we've already seen a rally and it was a little unexpected in some of these names like SAIL, Nalco, etc. Hindalco looked positive and has made a good move. So a lot of these names are already up 20 to 35%. So at current levels, risk reward is not good. So it would be a time to wait for a dip because it's a high beta sector. It tends to dip also in between. But at the same time, the mining space has been showing much better strength for the last many months. So if you look at the trends, they've been much clearer in a NMDC, GMDC, OMDC, etc. Even a Coal India, which is more on the mining side. So that would be the focus on dips. I would prefer going into mining names. So would wait out for a dip at current levels. It's a hold, not a buy in any of these names. One can look at the mid cap, small cap, specialty steel side of it, wherein we are seeing good breakouts in a Kalyani Steel, etc. But at current levels, the large cap metal names, the risk reward is not good. I think if I have to take a bet, only Jindal Steel still fits in because it's not made a fresh move after the new high.
That's the view coming in. Meantime, let's also get in a take then on some of those stocks that really were in the spotlight in yesterday's trading day. And the heavyweights had really dragged ITC, Reliance Industries. You also had an HDFC Bank that took a bit of a backseat. Kunal, what are the charts reading?
Well, they're still, so for example, for HDFC Bank, it's still on a bullish tone for the stock. I think it's shown a very good recovery of more than 14-15% from the October lows for itself, when the stock was at 1500 levels or slightly below those levels, towards a point when the stock had crossed the 1700 mark a couple of days back. So in the last 3 or 4 days, there has been a mild bit of correction for HDFC Bank. But then when we look at this in the context of the last 3 months of the price trends, it's still on the bullish side for the stock. So we'll have to wait out for a point where the stock breaks below the immediate support. And I think the immediate support for HDFC Bank, which we flagged off even yesterday, was around 1675 for the stock. So at least another 20-25 points further is where I would believe that the first test of a strong support could happen for HDFC Bank. ICICI Bank, on the other hand, has been an underperformer. So I think the stock has been closer to this 1000 mark for the last many days. Even though yesterday in the first half, we saw the stock showing signs of recovery, but we need to see those signs of strong outperformance for the stock, especially in times when the market fares up pretty well for itself. We've not seen that positive relative strength from ICICI Bank so far. So I think that's the only data point which I'll be waiting out for. But I think at current levels of 1000, it could also be a good contra buy for traders who are looking at such a kind of a behavioral trade.
Mr. Bhasin, I know we discussed the hospitality sector and you talked about Indian Hotels being one of your preferred bets there. But Motilal Oswal is calling Lemon Tree the top pick for 2024. They've hiked the target price on that one. They're saying the stock has been scaling new heights and it's reignition of the convention centers, which is going to boost the growth trajectory. So they're not only depending on the leisure travel, but also the business travel and the kind of conferences, etc. that's happening. What's your view specifically on Lemon Tree?
Yeah, so Anisha, we had a buy closer to 50 rupees and we've actually booked out of that. We want to stay with large caps. Like I said, Indian Hotel is in our portfolio, and as a conduit, ITC. ITC Hotels has 7,500 rooms franchise, and that is 10% of their entire business. So if you want to play the FMCG basket, the cigarette basket and hotel, then it's better to be in a stock like ITC. Also, Anisha, I'd like to put on record, 25th October was when my birthday was. You asked for a gift and I told you Diwali, and my birthday gift was Vodafone, 10.5, 11, as it 18.5. Yes, 75% in 2 months and rocking. So that is what undertone remains, that some of the stocks have given you huge return, but also be a little cautious because now the markets are, the final run of a bull market is always very, very pleasing, but very, very painful in the end. So learn to take some money off the table and stay invested in the best of blue chips. So Indian Hotel and ITC is where we play the hotel side. And if you have been following ET now and me, then take some money off Vodafone now.
Srivastav joins us, Senior Executive Officer, Marketing and Sales with Maruti. Shashank, good morning. Thank you for joining us. Now in December, sales are down on back of inventory clearance and plant shutdown. Do you think it could be back to basics, back to November levels starting Jan?
Yeah, so actually very successful. As you could see, from an industry point of view, the total wholesale were only about 287,900 against retail, which is now estimated to be about 443,000. So there was a sharp dip in the inventory levels in the industry from 331,000 at the beginning of December to now an estimate of about 176,000. And the same goes for Maruti Suzuki. Our wholesales were, passenger vehicle was just about 105,000, whereas our retails were 230,000 plus. So we could manage to bring down the inventory from around 165,000, 168,000 to the level of under 45,000 at the end of December. So in that sense, it's been a fairly successful month. And of course, the retail of 230,000 plus has been the highest ever in our history.
From Jan month itself, can we expect sales to bounce back to normal levels of sales? Could you give us a range?
As I said, this has been the highest ever retail in our history, the month of December. So it has to be a bounce down rather than a bounce back, because this is the highest ever retail at 230,000 plus. I don't think we can expect 230,000 plus type of retails going forward so quickly. Our normal average is between 130 to 140,000. But yes, in terms of wholesale, if that is your question, yes, you would probably see much better numbers than what you saw in December.
Okay, morning Shashank. So for the year ahead, what's the outlook then, especially when it comes to entry-level car demand? Do you think that we can see a smart bounce back this year?
This year, we have seen a decline of about 7% over last year for the hatches. So last year it was about 13,20,000. This year they were about 12,25,000 numbers. So about 7.5% decline. It's now about 30% of the overall industry, and we expect next year that it should be around the same levels. So one of the big reasons, of course, for the last few years of decline in the small car segment has been that the affordability has come down, which means prices have gone up faster than the income level of these category of customers. Going forward, I would expect that the affordability factor should get better, and if that is the case, you could see some sort of a bounce back. In fact, this year in the larger hatches, the premium hatches, we have seen a growth of about 4% for Maruti and about 2.5% for the industry.
So what is the price hike quantum then that you're planning to take in the month of January? And the question is, what is the percentage? Which models will see the maximum of it?
So as we have announced in the stock exchange, this price hikes will be across most of the models. But the quantum obviously varies depending on the cost structure of each model. At the moment, we haven't decided on the quantum or the exact date, but when we reopen, we will see that final round of discussions internally to decide what would be the quantum and when exactly the price hike would happen.
Okay, so then we'll wait by for more details on that price hike. But if you can at least share with us the latest order book number that you have right now in hand, and overall, what's your outlook for the PV demand in 2024? What kind of number do you expect the industry to grow by?
So PV demand for 24 should continue at a good levels, I would say, considering that most of the demand patterns are still quite stable. In December, we saw inquiries going up about 19%, bookings going up almost about 12%. So I would expect these large volumes to continue in 24. However, these are very high levels of volumes. 41 lakh, the volume for this calendar year is the highest we have seen in the industry ever. And from these high levels of volumes with the pending bookings now getting reduced, I would expect a small growth, a single-digit growth in the coming year, rather than a very large growth. So you would see a good level, a volume level, but in terms of growth, some muted numbers.
All right. Thanks, Shashank. Appreciate your time and best wishes for 2024. Bhasin Saab, are we in for a bit of a slow patch for autos, largely because run-up has been strong? B, let's be clear, the seasonality effect will kick in, whether it is December or Jan. And typically, I've always seen that, when you have one good year, the next year is not that great, at least for autos. I mean, it's always a cycle which is at play.
Correct. I am very much in tune with you, and I think we know the December and January effect. And if you heard Mr. Srivastava, he's telling you that they've never seen this type of numbers. So you cannot have a constant growth as we have witnessed in this year. I think the next year will be more moderate. You have just a statement of account on the budget. There will be other impediments, but the growth rate remains strong. However, like you said, Nikunj, stocks are priced above perfection. So there is no room for disappointment on monthly sales or quarterly sales. Even despite that, Maruti's again raised prices. So even though metals have not done that much of a input cost, their optimism is seeing price rises, which is what scares me. If DLF is launching new projects on Sona Road at 18,000, now these are crossing the affordable limits. Same is the case with a large part of the autos. They are actually pricing themselves to perfection, and any slowdown in demand can gradually see inventory build up. So yes, very, very cautious on both real estate and autos.
Cautious on real estate. I just want to get it right. You said cautious on real estate.
Yes, I have interacted. I've done the footfalls this time, and I see that the stock prices leave no room for comfort, because now the pricing is going beyond the common man's reach. It's the end use user. The end use user is already bought footfully. Now it's the speculation because of the wealth effect of gold and stocks, which is seeing this type of driving. And particularly, like I said, if the new launches which I saw, DLF at 18,000 square feet at DLF at Sona Road, it is far above the common reach. Any misstep in any micro development will again see these inventory levels not last. So be cautious there. Take some money off the table.
ये क्या है? Four things you've said you should sell. You have a reputation of being an evergreen bull. Book profits, real estate is not looking good. ये तो क्या हो गया जी? ईयर चेंज हो गया तो व्यू थोड़ी बदलता है वतीन साहब. You have a reputation of being an evergreen bull. देवेन भाई भी हंस रहे हैं, देखो वो तो हमेशा ही बुलिश रहते हैं. रिलायंस और इडानी की तो बात ही नहीं करी मैंने. या वसीम साहब.
निकुंज जी, हमने पैसा भी तो बनाना है, और पैसा वो है जो घर लेके जाओ. समझ आई ना? अभी आपको थोड़ा बहुत अपने आप को टोन डाउन करना चाहिए. The market is making money every day. I am very happy. I am a broker, and brokerages will do well. As a disclosure, we think that brokerages, insurance, exchanges, depositories, these are going to be the AMCs. These are going to rule the roost. So there are enough ideas. All I'm saying is, be cautious of some of the valuation outstretch. And when you get these big brokerage calls of absurd returns, I have a simple view, having worked so many years with FIs and others. When fools sell, you should be buying. When fools buy, you should be selling. Right now, if I have comfort, it is in some of the PSU oil marketing companies, some of the pharma names. And if you want, I can suggest two names which I think can outperform from here.
हाजी नाम बताइए. नेक काम में दूरी, नेक काम में क्या देरी?
So BPCL and IOC, HPCL are going to be the darlings for this year. Already HP, IOC have taken your breath with the move. I think BPCL is just poised to do that. Given that 8,500 crore was their profit after tax, EBITDA margin was at the highest. Refining margins will do well, but I would say BPCL is the dark horse from here to the budget. It can see a 20% move, and BPCL, even though it is all the distillate businesses with it, has underperformed actually the performance of HP and IOC. BPCL is something I'd put my money. The second is Lupin. Now, as a disclosure, Lupin has been in my portfolio for 8 years. It has underperformed miserably. It is just coming back now. But their generic pricing, their new launches are doing exceedingly well. And at 1,300, if I can buy one large cap blue chip, it will be Lupin. So I think 1,500, 1,550 on Lupin is very much on the card, and 550 on BPCL. These are two stocks which I can even buy at this price and be comfortable.
Lupin and BPCL, those are the top two recommendations coming in from Mr. Bhasin. On that note, we'll let you go, but let's take the conversation forward with Deven Choksi as well. Deven, hi, let's just start with that. Which is the PSU that you're still comfortable buying at the current level?
Yeah, good morning, Anisha. Well, I think most of the companies have probably corrected on the valuations, or rather, I think re-rated themselves on the valuations. So, from a perspective of looking at something which is very undervalued, I think that situation is no more there. the likes of REC, the likes of PFC, I think, which have performed significantly in the last year, I think they basically re-rated themselves in a given situation when I think after the cleaning up of the balance sheet and after I think seeing the surge in the offtake in the loans, I think they were still languishing at around 1.5 price to book value. They got correct, they got re-rated, and they probably I think got I think the valuation which they deserve today. Similar situation is happening with most of the public sector companies. Great models, great businesses, but the valuations have already, I think, reached to a level at which one could possibly say that look, they are now fairly valued at this point of time. So immediately there is nothing comes in the mind where one could possibly, I think, ask for buying into the portfolio. Maybe one will have to wait for the corrections in the market to buy some of the PSU companies if at all one wants to buy. I still believe that the PSU companies are great business models, but I think sustainability of the growth will have to be experienced by the market going forward in coming year. And as they are, I think government is spending on infrastructure. Around 15 to 20% kind of a growth is a safe growth to assume. Beyond that, if the market has assumed higher growth and given higher valuation, I guess I think some of these companies might end up giving a rude correction in time. So I think so one will have to be a little bit more careful about buying into euphoric condition into the PSUs.
Is looking euphoric in PSUs? Metals, power, railways, defense, because PSU itself is like a big basket of variety of businesses they will buy.
It's true, Nikunj, and I guess I think you touched upon metals. I believe that I think the metals could be one which could possibly be surprising the markets going forward. On one side, the demand situation is significantly improving. On the other side, the input cost, the energy cost is remaining on a lower side. And this is a perfect combination of formula for generating higher amount of profits in coming period. We remain distinctly convinced and bullish about, I think, the possibilities of metals giving the record performance in 2024 and beyond. So that is one space I think one would like to get into, whether it is PSU or private sector. But we believe that I think the companies could possibly end up giving relatively better performance in coming period.
Small caps moving this year. Small caps moving this year. Devin bhai, across the board.
Yeah, I think it's one of the reason for I think some of these small caps moving is largely that the values in the hands of individuals have actually I think increased in their portfolio, and as a result of which their ability to buy some of these small cap companies in the portfolio is remaining extremely high. In fact, if you notice some of the IPOs and the pre-IPOs also, most of the times I think the family offices and HNIs are the ones who want to bid for these companies in their portfolio. Largely because of the fact that their portfolio size itself has grown to such a size, I think more than I think some of the smaller mutual funds, that they are in a better position to buy into this company, and as a result of which higher demand is generated. Because of this higher demand generated, I think and the lower floating stock comparatively, the ability to buy into the portfolio remains extremely high for these HNIs and the family offices. And that is resulting into significantly stretched valuations, if I may add to use that word, in some of the small cap companies and the mid cap companies, where probably discounting has been far beyond 525 and 526. But to a greater extent, I feel that I think it is due to some of the shortages in the market as far as the new papers are concerned, given the size of money that the people are holding. That's a reason for which I think these companies are commanding higher valuation. Maybe they are due for some correction in coming period. May not be sharp correction, but it would be definitely a time correction that one would expect out of this company.
Interesting. That's the view coming in on stocks within the broader universe. But there's also, latest reports out on the NBFC space, which seem to suggest that now there is a bit of a marginal deterioration across metrics. Asset quality is going to be very keenly monitored, and you are going to see some growth pressures coming in for the likes of Muthoot Finance, LIC Housing Finance, PNB, Canfin, etc. So wanted to get in an expert view as well on, the entire sector and whether or not now the view is turning a little bit cautious within the entire NBFC basket. Would you tend to agree, Devin?
Yes, Evan. I guess I think most of the NBFC companies are having a good situation in form of collecting high deposits. And that's where the pressure is arising, that with the higher amount of deposit getting collected, they are also wanting to basically deploy it in a quick succession, and that's where mistakes are happening. I would rather like to stay with the larger NBFC companies like Bajaj Finance, like I think Poonawalla FinCorp, where the ability to lend, I think, is definitely there, but at the same time, ability to assess the credit profile of the borrower is extremely high by this company. So that gives you the confidence that these companies are unlikely to create non-performing assets in their books, and that too in hurry. So to a greater extent, I would think that I think one will have to stay with the quality player in NBFC space. May not be, you cannot be generalizing everything at one scale, and probably I think we'll have to remain watchful about the euphoric condition happening in some of these companies. So we believe that even if it is a gradual growth in companies like Bajaj Finance with around 30% kind of CAGR growth which continues, we believe that I think it is safer to buy and stay in these kind of companies than to buy into some of the smaller ones who are vulnerable to the situations.
Points higher is what GIFT Nifty is indicating, which frankly is not bad. Naresh, you'll appreciate the fact that how much we want you to smile, but you smiled only on day one. Let's continue the tradition.
There we go again.
There you go again. So nice of you, Naresh, to see you smiling. Okay, Naresh, what could make traders smile in the month of Jan? Will it be long, will it be short, or will it be no trade? I mean, there are three options for traders. Ride the momentum of November to December to Jan. Go against what the price trend is, which is start buying puts or start writing calls. Or third, just don't do nothing. I mean, just take a chill pill. What do you think traders should do in the month of Jan?
So the one thing which could make happy traders would be a new sectoral rotation wherein the market goes sideways and we see a sector doing well and you catch on to that. So for example, the last whole year, it was all about PSU. So going forward, if there is a new sectoral change, that could make us happy. But overall, this is a time one has to be much more cautious, a lesser trade, as you said. So it is difficult to have a no trade period, but overall cautious in the sense of sizing, because we've had a good run. The Nifty has moved up, the Bank Nifty has moved up, mid cap, small cap, everything has moved up. So a correction or a shake off could be normal. We've seen shake offs 3 times over the last few months, and we've seen a 3% cut on small cap index on a single day. So that's the risk, and that's the reason one needs to be controlling sizing rather than trading. So, and the best way to ride is to continue to hold on positions and control the size. So time to reduce some leverage rather than trading.
Fair enough. Of course, not very low volumes will be helpful to the traders, but at least churning is something that will excite some of the traders, definitely. But Devin, what's your view on Zomato specifically? There's an increase that has come in the platform fee, and while the number looks very small, it does have a very big impact on the profitability because it just kicks in at that operating leverage level.
Yes, I think they've tasted the blood. Last time, I think when they increased to 1 rupee, I think in the last year, I think it gave them a fantastic kind of a response also at the same time, because they did not see any kind of a drop in the business, etc. I guess I think that is giving them confidence to keep on adding this particular fee. Yes, I do agree that I think this is one area through which they can bridge the gap between the valuation and the revenue and the profits. That is where probably I think this company could give a star performance. However, one will have to be a little bit more mindful at this point of time in a situation wherein I think their ability to increase very rapidly these fees, I think would probably will come under pressure, given the kind of local presence that most of the retail food chains would have in their local areas. So obviously, I think today they probably may have increased the fees and they've been giving the better value services to the customers. But that ability would remain always restricted to a greater extent. So one will have to wait and see. As such, at this point of time, the stock is fully priced. To my mind, I think given the kind of possibilities, market has already discounted the stock price well in advance. So one will have to wait and see how exactly the growth in the profit comes out to justify the valuations at this point of time in the market.
17 points higher for GIFT Nifty. Kunal, what to your mind, and the same question what I asked Naresh, in terms of in trading strategy should be? Stay with the momentum, chalti gaadi hai, baithe raho. Second, go on the other side when the odds of getting it, if you get it right, are going to be disproportionately higher, which is just go against the other side. And second is chalti gaadi se utar jao, which is don't trade.
I think it always makes sense to not be adventurous in a moving vehicle, to put it very simply. So I think I'll stay with the trend, stay with the course for the indices in terms of staying long for the index. And I think it makes sense to hold on to long positions over here. So in every kind of a bull trend or an upward trend, there would be always those few odd jerks which happen in between. But if those few odd jerks they don't lead into any kind of a major trend reversal, then the resultant effect of that is that the market gets a push up higher. So just for example, I think last 2 weeks back or 2.5 odd weeks back, there was this sharp single day drop of more than 300-400 points on the Nifty. But what happened post that was the Nifty moving up from 20,900 to now 21,700, 800 levels for the index. So that's the kind of trend which we are looking out for. And yesterday was just a 50-100 point drop on the Nifty. So I think that should not deter a short-term trader, especially the one who's been holding on to long positions much prior.
Point taken. Devin, I wanted your view regarding the IT pack as well. Now, just at this time next week, we'll be perhaps talking about some of the numbers which are expected from TCS and HCL Tech and the likes, and the expectation is fairly muted. But if you look at the month of December or the last 1 month or so, Nifty IT has actually gained almost 10%. What do you make of this, and what should people do right now with the portfolio that they have in IT?
Anisha, I think one will have to wait for the commentary to happen, I think, post results in this particular quarter. It is expected that 2024 is a year in which most of the companies, the global companies, the customers of some of the Indian IT companies, are expected to give a good direction as far as their new order release is concerned. There is no choice left with most of the companies on two counts. One, because of the cloud computing, they will have to soon migrate to, I think, the entire infrastructure to cloud, which even today, the Fortune 500 companies, out of which only 30% of the companies have migrated to. So for the cloud computing pressure, I think they will have to migrate onto this particular infrastructure. Second most important trend change which we are observing currently is the trend change happening in case of AI and AGI. I believe that I think this is where the compulsion is coming for most of the businesses, wherein sooner they will have to adapt to the newer platforms, largely because of the fact that I think the business is demanding extremely high amount of data intelligence, as I would call it as. And that's where probably I think you are likely to see larger amount of order books flowing in to Indian IT companies. And I'm referring to some of the large cap companies, the Infosys, TCS kind of companies, where they are some of the larger customers who are giving them orders for a longer period of time. That is where I think we would like to listen to the commentary of this management. As far as the mid-tier IT companies are concerned, we remain fairly convinced about their growth program and growth trajectory, largely because I think they operate in the niche space. And I think somewhere we find that I think in this niche areas, they hold the dominance as far as I think their customer books are concerned. So to a greater extent, we find that this is going to be continuing growth opportunity of around 25 to 30%, particularly in engineering and R&D space, where we remain largely comfortable. So any correction in the price, I think that would be an opportunity to buy. But otherwise, look at the commentary which comes out from this management.
Tata Power, JSW Steel, JSW Power, NTPC, NLC, just about everything in the power space was really on 440. Even by they say that anything above 440 is dangerous in terms of voltage. Power stocks are doing more than 440. Should we be reminded of that danger sign wo har power board ke bahar hota hai na, that sign, cross sign? Is that the story for power?
I think on one side, the fundamentals are remaining absolutely convincing and intact. I think there is no questions on that aspect for most of the power companies, including, I think, the pricing tariff, which was up till now always having some amount of challenge in case of, I think, most of the power companies. Second side, I think the demand generation is now happening more from the renewable space. That is where I think these companies are relatively better placed than ever before that they were. So from that perspective, I think there is no challenge on that front. However, as you rightly observed, I think the valuation wise, most of the companies have reached, I think, to a peak level at which I think the comfort level is gradually reducing. I would say that despite of all the positives, if the valuations they go up in hurry, there may be a situation of some kind of a time correction, if not price correction, into these stocks, I think, at some point of time. One will have to wait and see. I'm not bearish, but at the same time, I would like to be a little bit more careful in adding the stock into the portfolio. Those who are holding it, I think they can continue to ride this particular wave, because the challenge is that I think most of the funds are requiring to deploy their funds. Every month, I think on the first day of the month, they end up having the 17,000 crore worth of SIP entering into their books. They have a challenge to deploy this money. So obviously, I think they would put money behind the areas where the ability to scale up would be high, even though I think the valuations are at reasonably comfort or high level or fair level. So from that perspective, I think you will see that sort of challenge. I think liquidity is driving the push as far as some of the power companies are concerned.
Okay, so those are the views coming in on the power sector and how you should one approach that, whether there is a danger sign brewing there or not. But before that, let me, thank actually Devin for making time and speaking with us. Appreciate you joining us today. Time now to take the mid-cap bets as well from a technical expert. So Kunal, what's the mid-cap idea?
So that'll be a buy on CESC, a stock which we've been flagging off over the last couple of weeks. Looks very attractive even at current levels of 135 plus, where the stock closed yesterday. The momentum is on its side. The stock has made a fresh swing high. So would look out for higher targets now, 144. Stop loss could be trailed to 130.
Okay, so CESC is one of the top bets. Naresh, what are you identifying?
So that would be a buy on Varroc Engineering, the stop loss at 530 and a target price of 650. The stock has given a multi-year breakout. The stock corrected from closer to 500 odd levels pre-COVID. Then in 2021 came very close to 450, 500. Again in 2022. And then in 2023 also took a pause around 500, took a little dip and then gave a breakout above 500. And now we are seeing a fresh range at 500 to 580. So a big breakout done of last 3-4 years, eventually expecting a breakout above 550 and a quick move to 650 and much higher in the medium term. And the whole auto ancillary pack, this has been one of the underperformers. Could be time for it to take charge.
Time now to take a quick breather on the show. When we come back, we'll discuss the pre-open rates in detail.